Hi all, in the second session we'll be discussing about cost of capital. This is the continuation of scope of financial management. Scope we have already discussed about investment decision, where we discussed about long term and short term investment decision, that is nothing but capital budgeting and working capital management. Now we are discussing about financing decision, where we completed the capital structure. Let's discuss about cost of capital. Cost of capital means cost incurred by the company to raise its capital. Capital, as you know, this is a combination of debt and equity. So from the company perspective, we can say this is the cost incurred by the company to raise its capital. From the shareholders perspective or the debt holders perspective, we can say that is the expected rate of return. Expected rate of return of the shareholders and expected rate of return of the debt holders. Cost of capital, generally riskier company has a higher cost of capital because the company has more risk. Obviously the shareholder as well as debt holder started demanding more. Their expected rate of return will be high, due to that cost of capital will be more. Cost of capital is a combination of cost of debt, cost of equity and cost of preferred stock. But most of the companies, we cannot find preferred stock in their books of account. So broadly we can say this is a combination of cost of debt and equity. Cost of equity. Cost of equity is the cost incurred by the company to raise money from the equity shareholders. From the shareholders perspective, we can say this is the expected rate of return of the shareholders. There are different methods we can measure the cost of equity. Capital asset pricing model, and the other one is dividend discount model. In capital asset pricing model, that we'll be discussing in detail in our fourth module. The cost of capital is equal to RF plus beta into market risk premium. RF plus beta into market risk premium is the cost of equity. Alright, this model will be elaborating in the fourth module. RF is nothing but the risk-free rate, which can be a GSEC yield, and beta is a measure of volatility. How to measure beta, again we'll be discussing in the fourth module. And market risk premium. Market risk premium means excess of market return over risk-free rate, RM minus RF. RM is the market return, meaning it is the return of any benchmark. It can be a return of Sensex or Nifty, and RF is the again GSEC yield. So this will help you to get the shareholders' expected rate of return. There are other model called dividend discount model. Dividend discount model, using that model also we can measure the cost of equity. But in this course we'll be focusing about on capital asset pricing model to measure the cost of equity. Cost of preferred stock. Cost of preferred stock generally lies in between common stock as well as debt instrument. It is in between debt and equity, because preference shareholders like debt, company has to pay regular dividend to them. So this is the cost incurred by the company to raise money from the preference shareholder is called cost of preferred stock. To measure the cost, annual preferred dividend by current market price gives us the cost of preferred stock. Cost of debt. Cost of debt is the cost incurred by the company to raise debt. In other words, the expected rate of return of the debt holders. From the debt holders perspective, this is their expected rate of return. Here we have to adjust the interest tax shield. You can look at the formula. After tax cost of debt is equal to before tax cost of debt into 1 minus T. Let's say the company has raised money from the debt holder, and company agreed to pay 10% interest rate. So the 10% interest rate is the before tax cost of debt, and company's corporate tax rate is, let's say, 30%. In that case, if you apply that in the formula, after tax cost of debt is equal to before tax cost of debt, that is 10% into 1 minus t, that is 30% tax rate is the company's tax, corporate tax rate. So in that case, after tax cost of debt will be only 7%. We have to consider that 7% as a cost of debt. Why are we adjusting the tax? Here is that we are getting some tax benefit when a company uses debt in their capital structure. See, when a company uses debt in the capital structure, company has to pay interest to the debt holder. That interest will appear on income statement under non-operating expenses. Due to interest, company's PBT decreases. Profit before tax decreases. Due to that, company end up paying less tax. So company is getting some tax advantage due to that interest expense. That is called interest tax shield. Due to interest, company is getting some tax advantage. To account that, here we are taking after tax cost of debt. This is the formula for weighted average cost of capital. In other words, this is the way to calculate cost of capital. Here we have to apply the weight. Weight is nothing but the capital structure. How much debt, how much equity, how much preferred stock in the capital. So weighted average cost of capital is equal to weight of debt into cost of debt into 1 minus t, because cost of debt into 1 minus t, this makes this makes this after tax cost of debt, then plus weight of preferred stock into cost of preferred stock plus weight of equity into cost of equity. Now I'll tell you a simple example. Company's DE is 1. Okay. Let's assume company has only debt and equity in the capital structure. DE is 1, meaning when DE will be 1, when debt is equal to equity, DE will be 1. So 50% debt and 50% equity. Alright, let's say the cost of equity is 12%. And the cost of debt is 8%. Generally, cost of equity will be greater than cost of debt. Why? Because equity shareholders are taking more risk than the debt holders. Right? Equity shareholders, suppose if the company is bankrupted, then they may lose their entire money, their entire investment. So equity shareholders are taking more risk. Due to that, their expected rate of return will be greater than debt holders' expected rate of return. So here, cost of equity is 12%, cost of debt is 8%. To calculate the weighted average cost of capital, we have to apply weight of equity into cost of equity plus weight of debt into cost of debt into 1 minus t. Now I have ignored the tax and all. So WACC is weight of equity into cost of equity plus weight of debt into cost of debt. Here I have ignored the tax and the preferred stock and all. So weight of debt, it is 50% into cost of debt is 12%. Plus weight of debt, that is again 50% into cost of debt, that is 8%. Now half of this is 6% plus 4% is 10% is the weighted average cost of capital. In a simple way, you can calculate the weighted average cost of capital. So WACC is the discount rate as far as the companies are concerned. This weighted average cost of capital is their discount rate. Discount rate, when that will be used, when they wish to convert their future value into the present value, they need a discount rate. So that WACC is their discount rate. Moving on to dividend. Dividend is another, dividend decision is another major pillar under value maximization. In order to enhance the company value, company has to decide whether to declare dividend or not to declare dividend. So based on their project availability, they have to take a call. So dividend is distribution of profit to the shareholders. Generally, this dividend payout ratio will be decided by the board members, and dividend payout ratio is nothing but dividend by the net income. Dividend is what percentage of net income. Retention ratio, generally if a company has a good project, then they will retain, and sometimes they will not declare the dividend too. So retention ratio is 1 minus payout ratio. Say for an example, if the payout ratio is 20%, then remaining 80% of the profit is retained by the company. That is the retention ratio. And dividend per share, like dividend by number of outstanding shares gives you the dividend per share, and dividend yield is dividend by current share price. So dividend also plays a role in enhancing the company's value. Dividend can be in different form. It can be a cash dividend or it can be a stock dividend. Company has to decide wisely about the dividend, because this dividend will play a very vital role on company's value maximization. Dividend, there are different theories, relevance theory and irrelevance theory. Some theory says dividend is relevant, meaning that will certainly affect the company value. And there are some theory which are irrelevant theory, which says dividend will not affect the company value. So it is important for the company to take the dividend decision correctly. Then only company can enhance the shareholders' wealth. So in the previous session, we started with scope, and now we are ending on scope of financial management. So broadly, raising and utilization of fund is all about the scope of financial management. Raising, we discussed capital structure and cost of capital. Utilization, it is about fixed asset investment, that is capital budgeting. Short-term investment, that is working capital management, and dividend policy, how to distribute the profitability of the company. So this is all about the scope of financial management. Now let's move on to the forms of business organization. There are different forms of business organization. Generally, it is broadly categorized into three: sole proprietorship, partnership, and company. Sole proprietorship, one person has started his business. It is a very simple business. One person has started his own business. It is called sole proprietorship, because he is the owner, he is the manager. There is no separation between the ownership and management. Generally in companies, there is a separation, because shareholders are the owner and board members are the managers. Whereas sole proprietorship, single ownership, there is no separation between ownership and management, less legal formalities, no sharing of profit and loss. Whether he makes profit or loss, he is going to enjoy that. And the main demerit of sole proprietorship is unlimited liability. When the business makes loss, the sole proprietor has to involve his own personal asset to pay off the business loss. That is called unlimited liability. Liability is not limited to any extent. It is unlimited. So if business makes loss, he has to involve his personal asset to pay off the business debt. And one man control. The second form is partnership firm. Partnership firm is the extension of sole proprietorship. Sole proprietorship, like only one person, so he can invest his own money. Whereas when he has to go for enlarging the business, then he can think of partnership. Here, minimum 2%, 2 or more than 2% join hands to start a business with a common objective, that is called partnership. And the Partnership Act is 1932. So the characteristics are 2 or more than 2%. And there is a contractual relationship, sharing of profit and losses. Here the partners, generally they have their own profit sharing ratio. Accordingly, partners will share their profit and losses. Unlimited liability. So this is also similar to sole proprietorship. Here the partners are having unlimited liability apart from minor partner. So again, unlimited liability. If partnership firm makes loss, then they have to involve their personal asset to pay off the firm's debt, except minor partner. And here, as far as India is concerned, the registration is optional, it is not compulsory. Moving on to company, an entity is registered under Companies Act 2013 or the earlier Act 1956 is called company. There are different forms of company: private company, public company, even one-man company. Basic difference between public and private company, these are the differentiation. Private we need minimum 2, whereas public the minimum is 7, and maximum in case of public company it is unlimited, and private company it is 200 directors, minimum number of directors. Invitation to public company of course has to issue the prospectus, and public company generally uses the word limited. The word limited follows public company name, and in case of private company the word private limited follows the company name. For instance, SR Limited. SR Limited can be a public company. SR Private Limited is a private company. And remuneration, there is no restriction in case of public company, and here in private it cannot exceed 11% of net profit. Statutory meeting is compulsory in public company. So public company means all listed companies. The companies which are listed on BSE or NSE are called public company, and all unlisted companies are called private companies. Private companies, if they wanted to list their company on BSE, NSE, then there are certain guidelines given by BSE, NSE, and the security market controller SEBI. So company has to adhere all the guidelines, then they can become a private to public company. So as long as the company is a private company, everybody cannot take part, everybody cannot buy the company shares because it is privately held. When it is a public company, anybody can buy these shares because it is available in the public domain. So this table shows the differentiation among these three forms of business organization. Sole proprietorship, only 1%, partnership 2 or more than 2%, and company, public, private, even one man can also form a company. Act, Partnership Act 1932, Companies Act earlier was 1956, and the recent one is 2013. Liability, sole proprietorship and partnership, the liabilities are unlimited except the minor partner, whereas company it is a limited liability. Company limited liability is the main advantage because here the shareholders' liabilities are limited. Let's say if you are investing rupees 1 lakh in a particular company, and the company is bankrupted or something went wrong in the company, you may lose that 1 lakh, not more than that. So your liability is up to the extent of your investment. So maybe you may lose your 1 lakh, not more than that. Whereas in sole proprietorship and partnership, the sole proprietor and partners, they'll have to involve their personal asset to pay off the company's debt. Separation between ownership and management, sole proprietorship and partnership, there is no separation. Whereas company, both are separated. Owners are the shareholders and managers are the board members. Voting right, sole proprietorship, not sole proprietorship, there is no voting is required. Partnership, 1 person, 1 vote. Company, 1 share, 1 vote. Company is an artificial person, whereas these two are not. And tax, company pays corporate tax, whereas sole proprietorship and partnership they pay income tax. That the profitability, the gains will be added with their personal income, and they will have to pay income tax. Limited liability partnership, this is a partnership, but it has the advantage of company. So this is a combination of partnership and company. This Limited Liability Partnership Act is 2008. It was introduced in the year 2008 because partnership firm only, but their partners' liabilities are limited. So they have the advantage of company here. Many partners are preferring this limited liability partnership firm now. So with this, we close the first module of this course, Financial Management for Beginners. We will continue the second module in the next session. Thank you.